Hello and welcome to 5 Year Club video number 231. Waiting for Absinthe to Filter edition, and man, it is taking forever. I've got my dining room light on for the first time in a while. That's why everything's so clear and you can see my beautiful facial hair. And well, it's not high resolution because this camera's crap, but whatever. Alright, I want to talk about capital gains tax today. I want to talk about it because I met someone the other day who had owned and flipped 4 homes in the last 9 years, I guess. And when I heard that they did that, I thought to myself, that doesn't sound very efficient. And I'm going to tell you why. Number one, because if you are using a real estate agent to sell these homes, the real estate agents, the buyers and sellers agents in the U.S. usually take about 6%. And that's not 6% of the profit. That's 6% of the total value of the home that you're selling. So if you're not making at least, well, it's not 6%, but if you're not making at least, I don't know, 10% on the property, then, that realtor fee is basically sucking up all your profit. Unless, the price just rose really dramatically, like 200% or 300%. So that's one reason, realtor fees. And other like sale related fees. You got to pay a little bit of money to clean the place up and repair things and whatever to get it ready to go. And the second reason is capital gains taxes. And I wanted to talk about that today. So I'm going to read this article. It's going to discuss the capital gain exemption, which is something that you can benefit from if you own a home. In other words, your primary residence. I've mentioned it before, I'm sure. But also just capital gains in general, because that term, you'll hear that term, a capital gains tax, as you get older, as you invest more, as you own some stocks, and as you own some real estate. Homeowners get a big tax break when they sell, a capital gains tax exclusion. All right. Homeowners already know the many tax breaks that Uncle Sam offers, most notably mortgage, interest, and property tax deductions. Well, he also has good tax news for home sellers. Most of them won't owe the Internal Revenue Service a single dime. When you sell your primary residence, you can make up to $250,000 in profit if you're a single homeowner, twice that if you're married, and not owe any capital gains taxes. Most people are not going to have a tax obligation unless their gain is huge, says Robert Trins, senior analyst with Thomson Reuters Checkpoint. What is capital gains tax? Capital gains tax, or CGT, is a tax imposed on the profit, capital gains, resulting from the sale of an investment. For example, capital gains are commonly realized after the sale of stocks and property. To calculate capital gains, subtract the purchase price from the sales price. So yeah, if you make any money owning something, the U.S. government wants to steal part of it. Some sellers are surprised by this break, especially if they've been in their homes for a while. That's because before May 7th, 1997, the only way you could avoid paying taxes on your home sale profit was to use the money to buy another more expensive house within 2 years. Sellers age 55 or older had one other option. They could take a once-in-a-lifetime tax exemption of up to $125,000 in profits. And in all instances, there was Form 2119 to fill out to show that you followed the rules. But when the Taxpayer Relief Act of 1997 became law, the home sale tax burden eased for millions of residential taxpayers. The rollover for once-in-a-lifetime options were replaced with the current per-sale exclusion amounts. There is some logic to this law change because most people under the prior rules didn't recognize a taxable gain because they rolled it over into another residence, says Trends. The change essentially makes it easier to dispose of your residence. Still some requirements to meet. If you used pre-1997 rules for residential sales, don't worry, that doesn't disqualify you from claiming the exclusion on any residential sales now. The law change applies to all sales since it took effect. Another bonus to the changed rules, you don't have to buy another home with your sale proceeds. You can squander the money any way you like. Even better, there's no limit on the number of times you can use the home sale exemption. In most cases, You can make tax-free profits of $250,000 or $500,000 depending on your filing status every time you sell your home. There are a few rules to follow, of course. First, the property you're selling must be your principal residence. That means you live in it. This tax break doesn't apply to a house or other property that you have solely for investment purposes. In those cases, the usual capital gains rules apply. Yep. So if you buy some kind of rental property and it's not your primary residence, which I believe by their definition means that you've stayed in it for like 3 out of the past 4 years or 2 out of the past 3 years or something like that. Oh, there we go. You also must live in that principal residence for 2 of the 5 years before you sell it. This is known as the use test. It also means, practically speaking, each sale must be at least 2 years apart. That still leaves you room to make some money on several properties. You can sell your residence this year, pocket any gain within the tax limits, and buy a new residence. Then 2 years later, you can do the same thing again and again every 2 years. And you no longer have to worry about that pesky prior law reporting requirement. When your gain doesn't exceed the limit, you don't have to file anything with the IRS. Second home sales take a tax hit. Owners of multiple homes, however, will now find it's not as easy to shelter sale profit as it used to be. A provision of the House Assistance Act of 2008, the bill designed primarily to provide relief to some homeowners facing foreclosure, could cost owners of a vacation or other type of second home property when they sell. Previously, you could move into the second property, make it your primary residence, live there for 2 years, and then sell it and pocket most or all of the profit. Now, however, even if you convert a second piece of real estate to your primary home, you'll owe tax on part of the sale money based on how long the house was used as a second rather than as your main residence. Blah, blah, blah. Rules for married couples. They get $500,000. So bottom line is that if you are, buying a second residence and you're hoping to fix it up and flip it, you better get a hell of a deal on that place. Otherwise, a lot of if you have any gain on it, it's going to be taxed away. If you're not personally a contractor, it's very possible that any contract work that you pay to fix up a place is not going to go into your pocket. It's going to go into the contractor's pocket ultimately. And so, yeah, this is kind of a bummer on many deals, is that the government is like, nope, I'd rather have your money than you do something productive to fix up a property. All right, how does this apply to stocks? Well, with a stock, if you own the stock for less than 1 year, you pay your normal tax rate on it, I think, or your 35%, one of the two. And that's called short-term capital gains tax. And if you own it for more than 1 year, then you pay the long-term capital gains tax, which is generally 15 or 20%. Oh boy, I'm tired. And that means that there is a large incentive to hold a stock for more than a year. Yep. Okay. Yeah, especially if you're already in a high tax bracket. Okay, well that is it for 5-Year Club video number 231. I hope you enjoyed it. I hope it was a reminder of some of the complexities around real estate, and specifically why a buy and hold strategy in real estate has a lot of advantages, because you are not taxed, and you do not have to pay the real estate agent when a sale occurs, because no sale occurs. You're just chilling out in the property. Have a fabulous evening.